Do you think, Gene, that there's enough safeguards in place to prevent another meltdown?
Yes, but probably not the safeguards that most people think of. I think it's the mentality here that, that we are all better if we all share and collaborate. About $1 trillion has left the banks and brokerage firms and gone independent.
Welcome to Silicon Valley Business Pulse, your online news magazine that features in-depth conversations with people from business, politics, and the arts, with your host, Esme St. James. Tonight, Esme's guest is Gene Sinclair, Principal, GW&Wade. And here's Esme.
Hello, everyone, and welcome to the Silicon Valley Business Pulse. I'm Esme St. James, your host. Welcoming to our show today, Gene Sinclair, Principal at GW&Wade. Hi, Gene. Thank you for joining us.
Esme, nice to see you.
My pleasure. Tell us a little bit about what you do. I'm really interested to find out.
When I work, you mean?
Yeah.
I'm a partner at GW&Wade in Palo Alto, and I'm in charge of business development for the Western United States. It's a $5.5 billion wealth management company. Actually just rated the 13th largest in the country.
So. $5.5 billion. You've grown since, like, I looked some things up last night and it said 4-point-something billion.
Well, usually that information is a little bit obsolete.
That's huge.
But great, thank you.
You're welcome. Tell me, what really floats your boat about your business? What do you love the most about it?
Great question. Helping people. We had a couple in this week. They're looking at a $20 to $25 million exit, and there are several things that we showed them that they could do to maximize that, that they were not aware of.
Interesting. Do you work mostly with individuals, or are businesses also your clients?
Mostly individuals. Occasionally we'll do a 401k plan, an endowment, other institutional accounts, but mostly individuals, families. We're like a multi-family family office.
Okay. That's making my head spin. Of course, it doesn't take much. Wondering, what is your take on the Silicon Valley area? I know it's unique from other areas of the country, and I also know that you're from the East Coast, so give me a little compare, please.
You have a couple of hours why we're different here?
Oh, we got 20 minutes.
Well, obviously the weather, the
Yes.
proximity to wine country and skiing and surfing, but I think it's the mentality here that, that we are all better if we all share and collaborate. There's no, well, not no, but there's less territoriality about investment or intellectual property.
Okay.
Obviously there's patents and you need to protect things, but just the collaborative atmosphere, the open networking, the common goal to just find a better way to do things. It's more prevalent here than any other place I've ever been.
You know, that's interesting. I've never heard anyone say it quite that way, but now that you mention it, I have noticed that there's so much more, yes, collaboration and helping each other out rather than what's mine is mine. And I notice a bit more of that on the East Coast myself, too.
It's kind of like I used to, when I coached baseball.
Yeah.
It's like help your teammates to be better players, because that'll make you a better player. And I think that just permeates this area.
Is it because of the weather, do you think?
That has a lot to do with attitude, yeah, but that's part of it.
Yeah, I've actually read somewhere online that in San Jose, people are the happiest from anywhere in the country, and it has got to do with the weather, definitely. Do you find that because the industry here is so technology-oriented that you attract a different kind of client, or that there are different challenges for them than you might find elsewhere?
I think the challenges are that people are very much more technically oriented here. They tend to be so involved with their core competency that they don't get fundamentals in other areas like finance and tax and legal. So in a way, they need our help more than other people in less focused, less intensive industries.
So what you're saying is that really people aren't as focused on their money as much as the business of technology when they're in that area. And so they need more guidance, perhaps.
Yes, in fact, that you mentioned money, I think people out here are so focused on doing things better that the money is not the immediate goal. It just comes with it.
Okay.
So in a lot of ways, we help take care of the money that their genius creates and keep it out of their way so they can continue to innovate.
I like that. Yeah. How do you find that your business is affected by the economy?
Well, since we invest clients' money in the premier markets, very affected by the economy, which is not related to the local community, but the world economy. And as you know, we've had a couple of events in this century that have kind of rattled people, and yet we've recovered, and the resilience of the economies are just amazing to me.
So how did you, I know you've been in this business for quite some time in these parts, and you went through the dot-com crash as well as the crash in 2008, 2009. How did that affect your business, and what did you do about it?
Great question. In fact, I've been through 6 of these crashes in my career.
Wow.
But the last 2 have been somewhat unique. They're always unique, but I think a little more broad and dramatic. But what we've done is diversified more, done more non-traditional market investing.
What is that, non-traditional market investing?
It's commonly under the category of hedge investing, all our alternatives. But it's really to get some of the assets that our clients create with their genius out of the traditional markets. So if we get a broad meltdown like 2008, it may not affect them as badly.
So basically don't put all your eggs in one basket and do some things differently from before.
And part of the problem is that the traditional markets are now almost in line. So used to be bonds and stocks moved oppositely.
Yeah.
Now they're in tandem. Global markets in tandem. So you have to get some assets in a completely different strategy, I think, to get away from that coordinated risk.
You invest your clients' money in different things all over the world, like globally?
Well, actually, we're a manager of managers.
Oh, okay.
So we find managers that are effective in different asset classes, geographic areas, and rely on them to understand those areas and help our clients.
Great. Since the last crash in 2008, 2009, do you find that people in general are looking at financial advisors from a different perspective?
Yes.
Okay, how about the long answer? I want to know what you think.
Well, like I said, they're all unique, but 2008, I think a lot of people realized that some of the bigger banks and brokerage firms were not always on their side.
Oh, really?
And we've seen a major exodus. The industry has seen a major exodus from those companies and toward independence. We call it the $1 trillion march, if you will.
Tell me about that.
Companies done some surveys and they found that between 2008 and 2014, about $1 trillion has left the banks and brokerage firms and gone independent.
So to independent advisors.
Right.
Ouch.
Well, you expect me to say that since I'm an independent advisor, but we didn't do the survey.
Yeah. That's really interesting. Wow, I had no idea.
And even advisors are leaving those business models and going independent.
Fascinating. Wow. So do you feel that investment philosophy has changed in the last 10 years, and how?
Like I said, I've been through 6 of these.
Yeah.
And I don't think people have changed. So I don't think their philosophy has changed. With the exception of the last, which I think kind of shattered people's confidence in the entire financial system.
Really?
As well as the markets.
Yeah.
And now that's been gradually restored. But it took a little more getting over
I guess so.
than some of the previous ones.
Yeah. So people got a little bit cold feet kind of thing.
Well, it was just the magnitude and the global nature of that and the scariness of it. that it literally was a credit freeze.
Yeah. I know, even if you had lots of money, you couldn't even get a mortgage or anything. It was
Right.
like, forget about it. It's like, well, which was kind of counterproductive.
Right.
Yeah, kind of.
So, I mean, that was the unique aspect of 2008.
Okay. Where do you feel Silicon Valley going within the next 3 to 5 years or so in general and within your business?
Well, they keep getting younger, smarter, and wealthier. So,
Okay. Yeah, I've noticed that around here, Jane. Yeah.
as our clients have.
Yeah.
But again, they have that focus, that intensity,
Uh-huh.
that sometimes they're missing opportunities to optimize their opportunities, their equity,
Yeah.
and that's where we help them a great deal.
So do you find that more often than not you have to like go out and tell people about what you do, or do they automatically come to you for help around here?
We grow almost entirely by referral,
Oh, really? Mm-hmm.
but since we're relatively new out here,
Okay.
I had to kind of stimulate that process a little bit.
Yeah. So what'd you do?
We did some events,
Uh-huh.
some related to financial subjects, some not, that got our name out there. And then about 3 or 4 years in, I sat down with a venture capitalist for the first time, was a prospect. And before I hit the seat,
Yes.
he said, "I've been hearing about you guys everywhere."
Oh.
I thought,
And
okay,
that's kind of nice.
I
It's
think
working.
I'm doing my job.
Yeah, it's working. And do you find that you have to, or had to build a big online presence since everybody's looking for everything online here? I mean, even to go find a place to fix my shoes, I go online and check Yelp or whatever to see who's good. I never used to do that. Do you find that you need to be out there a lot?
Certainly,
in that
social
way?
media is
Yeah.
part of our, getting known to the world. We've gotten much better at that
Yeah.
lately. Unfortunately, we're a very regulated industry, so the testimonials, the Yelp sort of thing, we can't do.
Oh, right, okay.
Recommendations on LinkedIn, we can't do. We can't accept. So we're hamstrung in some respects that people wouldn't think of,
Yeah.
but we just have to live with that.
Yeah, you seem to have worked it out quite nicely.
Thank you.
Yeah. Do you think, Gene, that there's enough safeguards in place to prevent another meltdown?
Yes, but probably not the safeguards that most people think of.
Oh, tell me more.
Like all major financial events, 2008 was a little complicated, but and there was blame to go around, plenty of blame.
Plenty, yeah.
But the 3 major factors, in our estimation, the vanishing mortgage standards,
Yeah, that was scary, huh?
the banks relying on Fannie Mae and Freddie Mac as mortgage buyers of last resort, and Wall Street really assuming they were too big to fail because of the bailout of Bear Stearns.
Overconfident.
Right.
Yeah.
Well, and kind of a moral hazard that they could take risk and the Fed would back them up. Well, look at what has happened.
Yeah.
I think the banks and the brokerage firms have wised up to recycling toxic loans, sometimes called ninja loans.
Oh.
No income, no job or assets,
Ooh.
and people were still getting loans.
Yeah.
Fannie Mae and Freddie Mac are now in taxpayer receivership and probably won't last. And the Fed, although they stepped in appropriately and kind of restarted the credit cycle and recapitalized the banks, they're not going to do that again. So I think learning the lessons and realizing that there is, the moral hazard is gone is our safeguard.
Yeah. No, that's a good answer. I like that. I want to find out more about some of our challenges, but first we're going to take a little break for a word from our sponsor. We'll be right back. Hi there, I'm Esme St. James, President of the Style Force, image consulting for men and women. When working with me, my clients feel more confident, get more business, and actually even get a little boost in their love lives. I simply love the transformation that happens when my clients put the pieces into motion and actually do what it takes to become who they're meant to be. Esme St. James with the Style Force, where first impressions become success stories. And we're back with Silicon Valley Business Pulse. Our guest today is Gene Sinclair, principal at GW&Wade. Well, welcome back, Gene.
Thank you. Great to be back.
I've got a couple of more questions for you. Are you
I'm
ready?
ready.
Of course you are, because you're Gene Sinclair, huh? Okay, first of all, do you find that millennials want to invest differently than, let's say, the traditional investor around here?
Great question.
All right. You got an answer?
I'm working on that.
Okay, good.
Yes, in some ways, I think they're less focused on money, not completely unfocused on money,
Okay.
but perhaps compared to a more traditional investor.
Okay.
More focused on the technology or the innovation or
Yeah.
disruption that helped create that money.
Okay.
They seem to be very interested in social investing.
Social investing, tell me about that. What's that?
Is sustainable enterprises, energy efficiency, addressing some of the major kind of global concerns.
Like green issues?
Right.
Yeah.
And as well as staying away from some issues, tobacco companies, those sorts of things.
That's kind of
Which
nice
is
to
not
know.
uncommon
Yeah.
among more traditional investors. I think this generation is just a little bit more focused on that.
Yeah.
And I think because many of them don't yet have families or spouses or mortgages, much freer to entertain a broader range of investments and to have a much longer time horizon.
Oh.
Someone in their 20s or 30s has a different time horizon.
Yeah.
Well, without kids and mortgages, maybe a dog and a foosball table, than somebody who has 3 kids in private school, a couple of mortgages, taking care of the parents or the in-laws, and only 15, 20 years to go to retirement.
So they're more apt to do something that will create a long-term result for them and perhaps still leave a legacy, but then they don't need the immediate funds or like 20 years from now or 15 years from now, I'm going to need to retire and I got to take care of myself and my kids.
Right. And they can also be more generous, more philanthropic.
Okay.
And we help them find the most efficient way to get assets to others, either family members or other organizations that they support. So there's always a more efficient way to do it than the first impulse to write a check.
Okay. That's very interesting. And now that has me curious, do you find that the millennials are more apt to take bigger financial risks than the more traditional investor?
Yes.
Okay, then. There's more.
Yes, there's
Okay,
more.
good.
Again, because of their time frame, much
Yeah.
longer time frame, a much lower personal financial responsibilities, and so many of them correctly believe that their first or second or even third exit or enterprise or startup is not going to be their last.
Oh, that makes sense.
So again, what we try to help them do is have some longer term targets, some intermediate term targets, but also keep some assets in reserve, because we know that as soon as they're able, a lot of them are going to go out, quit their day jobs and go start another company and maybe go without an income for a couple of years or substantially reduced income. So we want to reserve assets to preserve that opportunity for them. So it's a different picture there than a senior executive at a company that has pretty much the rest of their assets and liabilities kind of laid out.
It's very different. Do you find that more fun sometimes to play with that in that realm?
It is different.
Yeah.
Much because you kind of live vicariously through them.
That's what I mean. Yeah, it's kind of
Yeah.
like, oh, let's play with their money.
Well, not
But,
play.
well, no, I know,
I
but
know.
you know what I mean. Like, let's try some new things or different things from what I'm used to or what
Right.
you're used to.
And at the same time, it's so rewarding to help a family
Yeah.
that may, have wonderful opportunities and plenty of resources, but just optimize them and not worry about the details and get to their financial objectives.
Yeah.
And have assets, for philanthropy or whatever else they want to do.
Yeah, and I'm sure that you feel very good working with somebody like that who is philanthropic, because you're really, anyway, helping them help other people.
Correct.
Yeah, that's kind of cool. In my books, anyway.
Thank you.
Yeah. Jean, tell me, I'm wondering, what are some of the biggest challenges that are unique right now with investors?
I think there's three.
Okay.
In particular. The biggest one is the seemingly permanent negative interest rate environment that virtually globally we're in, with the exception of some emerging market countries' debt. But there's a coordinated central bank stimulative monetary policy going on since the 2008 crash. That's keeping interest rates down, and in fact, maybe even curtailing growth to some extent.
Okay.
But there's no returns available from the traditional bond markets into anywhere near what we're accustomed to. And at the same time, there's some very repressive monetary or fiscal policy occurring, in that, high taxes, regulations as a result of 2008. So you've got one foot on the brake and one foot on the accelerator, and the liquidity that's being created is being driven into the stock markets, Wall Street versus Main Street, until some of this is resolved. And the way it usually is resolved, and we appear to be getting close to that, is better fiscal policy, more pro-business policy, eventually emerges and reduces the need for less than ideal continued stimulation. And as we saw, like yesterday, the big jobs report, the market went down almost 300 points instead of up.
I saw that, yeah.
Everybody
What's up with that?
"What?"
It's like, oh my God, it's happening again.
Again, we're kind of at that transition point where the strictly just stimulative monetary policy is going to give way to hopefully more expansive fiscal policy that will enable businesses to invest for the long term again, hire employees, do capital investments, and raise productivity again, which has been sorely lacking in this recovery.
So you think things are going to be normalizing again a bit?
Yes.
Sort of.
Yes.
Great. How does an individual with a net wealth of over $15 million invest differently from the person who has under $1 million?
Another great question.
Oh, full of them.
There's kind of a myth out there that the more money you have to invest, the more exotic your portfolio should be.
Really?
In a way, the opposite is true.
Oh, tell me why.
Because the more money you have to invest on a discretionary basis, really the less risk you need to incur to achieve your financial objectives in most cases.
Right.
So in effect, your portfolio could be less risky, less exotic, if you equate exotic with risk.
I guess, yeah.
Right.
I guess I do.
And again, I think the one thing that I think both the $1 million and the $15 million investor, or the sub-$1 million investor, might be advisable to consider is getting some of their wealth out of the traditional markets, because they are now operating so much in sync, where they used to offset each other, with some well thought out alternative or hedge strategies that, again, because of sort of modern technology, some of those alternatives are even available to the sub-$1 million investor in the right circumstances.
Oh, that's refreshing to know.
So,
yeah, that's great. Final question, Jean, and I'm sure we are all interested in the answer to this. What is the best piece of advice you can give the average investor now?
Another great question. And it's not a yes or no answer.
I hope not.
Well, let me quote a study that appears to be the most objective, independent, long-term, comprehensive study of investor behavior. It's called the Dalbar Report. It's been published for 20 years, and it examines 30 years of investor experience.
Is it D-A-L-B-A-R?
D-A-L-B-A-R.
Okay.
And the result of that report is that the average investor doesn't achieve remotely near index returns in the stock markets, the bond market, and even in an asset allocation portfolio. In fact, in the 30-year period, the average investor has only achieved about a third of the index return in the U.S. stock market.
Wow.
And less than a tenth of the U.S. fixed income market return.
Ouch.
So even if you think you're twice as smart as the average investor, chances are you may be woefully below indice returns. So the idea that you just buy an index and you're going to get index returns is not
Like hope for the
borne
best.
out by the Delbar study, and there's other studies too.
Oh, interesting.
So I guess the best piece of advice is don't go it alone. Get some help in getting a better achievement relative to the indices.
Oh, that makes total sense to me. Jean, thank you so much for coming onto the show. I really appreciate it, and
My pleasure.
I hope to see you again soon.
Great.
I'm Esme St. James signing off for Silicon Valley Business Pulse. See you soon.